Hello, everyone. As part of our ECON 232 economics project, we'll be talking about the dumping of US bonds by the Chinese and its effect on the world economy. I will be your presenter today, and my name is Anthony Bitar, alongside my colleagues Lilia, Chahine, and Maher Zeineddine. In this video, first of all, we will give a brief introduction about bonds. What are bonds and what are the different types of them of bonds? In second, we will talk about the global shift away from the US dollar. In other words, we mean the selling or the dumping of bonds and its implications on the economy. In third, we will talk about the rise of gold reserves, and this is correlated with the fourth point, where we will try and argue whether the central bank's increasing interest in gold reserves is a sign of de dollarization. Maybe yes, maybe no. So, in first, what are bonds? A bond is a loan, but instead of you borrowing money from a bank, you are the one who is actually lending money. When you buy a bond, you would be lending money to either the government, municipality, or corporations. And this will get us to these type of bonds. They can be government bonds or corporate bonds. In return, the people that you lend money via buying this bond will agree to return you the full amount at a certain date called the maturity date. So at the maturity date, let's say you paid X amount of dollars, you get paid the full amount, which is X, plus the interest rate that you agreed upon. So to explain it further, the Chinese government has been buying bonds extensively from the US, aka they were lending the US money. We want competition with China, but not conflict. Here, what does the president mean by conflict? Is it the threat of the dumping of bonds by the Chinese? The economic relationship between China and the US is pivotal for global economic stability and growth. As the world's two largest economies, their interactions impact international trade, investment flows, and the broader economic landscape. Cooperation between these two countries can lead to advancement in technology, sustainability, and economic development, not only in the US and China, but in the whole world. I mean, of course, tensions may result because of volatility in global markets. However, this dynamic underscores the importance of a balanced and constructive economic partnership, which influences everything from global supply chains to currency valuations and setting the tone for international economic policies and practices. As of December 2024, China's investment in US Treasury securities exhibited a notable increase, reaching approximately $870 billion. This movement in holdings is significant. It reflects China's ongoing role as a major foreign holder of US debt. The adjustment in Chinese Treasury securities portfolio can have implications for the US bond market, influencing interest rates and the cost of borrowing for the US government. And we will get to that point later in the video. Such dynamics underscore the complex interplay between Chinese investment strategies and the fiscal health of the United States, highlighting the intricate economic ties that bind the two global powers. Okay, so just to give a small historical context, in the late 1990s to early 2000s marked a significant period in China's economic history, and it was characterized by profound economic reforms and a strategic opening to global trade. And this led to a substantial increase in its export volumes. And the pivotal moment was China's actually accession to the World Trade Organization in '01, in 2001, and this solidified its role in global commerce. During this era, China managed its currency by pegging it to the US dollar, and pegging its currency to the US dollar further promoted its export driven economy. We can buy from China, So China exports its product and it deals with the dollar. And this currency management facilitated the accumulation of massive trade surpluses, particularly within the US, and consequently led to the growth of foreign currency reserves. And therefore, to manage these reserves and to maintain currency stability, China turned to purchasing US Treasury securities regarded as safe and stable investments. And this tactical acquisition of US debt was a central component of China's economic strategy to sustain continuous economic growth and secure a competitive advantage in the international marketplace. Two out of three biggest foreign holders of the United States debt, China and Japan, have been selling their holdings of the US Treasuries for over a month. Right now, they are the lowest levels in decades. While there are several reasons why foreign countries that own approximately one third of the US debt are collectively getting rid of it, and the underlying sentiment is unmistakable. They don't want anything to do with the United States dollar. While it takes a while for a global reserve currency to lose its status, the process has already begun. Now that Saudi Arabia sells oil to China, the biggest importer of crude oil in the world, using the Chinese yuan, and economies such as Brazil, China, and India are choosing to transact in alternative currencies, the fiat dollar has a lot to lose. So, as China and Japan, the biggest US debt holders, are actively repatriating their capital, they need safer assets for investments during these times. These times of severe economic hardship and uncertainty, precious metals fare very well. And by precious metals, we mean gold and silver. So, gold and silver become the safest store of value. And those countries that are not party to the Western Club are learning the rule very quickly. So, it's really not surprising that China has been stockpiling gold for a month and its precious metals reserve just hit a new unseen before milestone. But first, let's quickly run through some numbers so that you can see how quickly the US Treasuries are losing their status of a quote unquote completely safe investment. Since 2018, China's holdings of US Treasuries declined approximately 30%. And as of June the 13th, China's China's US Treasury holdings fell to 18 to $835 billion, which represents a fresh 14-year low. It is true that China has been selling US treasuries for over a decade, but what's worth noting and what's really concerning is that the rate of these sales has accelerated recently. So, what is the effect of this accelerated dumping on the US? So, the rapid selling of Chinese bonds would likely result in an increase in bond yields. And what are bond yields? Bond yields represent the return an investor will receive by holding a bond until maturity. It's effectively the interest rate paid by the bond issuer, aka in this case the US, to the bondholder, which are the Chinese, and usually expressed as an annual percentage of the bond's face value. So, the interest rate with the bonds. Higher yields indicate higher returns for investors, but also can also suggest higher risk or expectations of rising interest rates. So, an increase in the bond yields. This is because bond prices and yields move inversely. As sellers flood the market with bonds, the prices of these bonds will drop, necessitating higher yields to attract buyers. So, it's a basic supply and demand case. If we have 100 bottles of water, and so this is the total supply. If I was to buy the 100 bottles for a dollar each. Okay, so when I bought the bottles, the supply is then zero, then the market price of the bottle will increase. But when we further supply the market with a lot of bottles of water, the price will decrease. So an accelerated dumping means an accelerated supply of bonds means that the price of the bond will decrease and the price of the bond and yields move inversely. So when the price of the bond decreases, the yields will increase. So this scenario could elevate borrowing costs for the Chinese government and businesses. and it will impact economic activities and potentially lead to broader implications in global financial markets. And this includes shift in investor sentiment and adjustments in international investment flows. In just the last few weeks, Beijing has sold off 10% of its entire holdings of US Treasuries, and it's been cutting its holdings for the third month in a row. Several weeks ago, in August, China's central bank official essentially said that the security of Chinese holdings is becoming an increasingly important geopolitical issue. So it's really not a surprise that as tensions between China and the West heat up, there are less and less incentive for China to hold these massive amounts of American debt. Japan's massive US debt holdings are at historic lows as well. Japanese investors will likely pull even more money out of the US Treasury market soon. After the United States sanctioned Russia's reserves, it's really no surprise that China and Saudi Arabia, whose exposure to the US Treasuries dropped 40% as of August, are now making every effort possible to preserve their capital, dump US Treasuries, and to be in control of their assets. So, where do these countries invest their cash? I mean, this is the question. China has been purchasing gold at unprecedented rates. The Chinese central bank has been adding more gold than ever before a 10th straight month. I mean, do you consider this as a de dollarization? Yes or no? Reportedly, China has led central banks buying in recent months. Its main goal is to diversify its reserves because of economic and geopolitical risks. China added nearly 7 million ounces in gold reserves, bringing the country's official gold reserves to a new record high. It's very likely for the People's Bank of China, the country's central bank, to further boost its gold reserves, said an analyst at financial trading platform. It's called FXTM, and it's posted in the link in this video. I recommend that you watch it. As China reduces holdings in US debt, the country needs to increase holdings in other assets, and gold is a rare, high quality credit asset in the current environment. So the shift away from the US dollar undeniably weakens it. And as foreign debt holders continue to sell their US treasuries, and as the Federal Reserve also continues to issue record amounts of its debt on the market every single month, we should expect the current global reserve currency to lose its appeal and weaken eventually. I mean, the risk of being sanctioned is just too much for foreign countries to accept. I mean, who can accept that you sleep, wake up the other day, and your money are frozen? And this is what's happening to Russian oligarchs right now. Okay, so the shift away from the US dollar and the shift to gold reserves has been anticipated by many central banks. For example, the World Gold Council recently published a survey in which the majority of central banks believe the reserves denominated in US dollars will decline to 40 to 50% within the next 5 years. But here's the catch. The same survey shows that 7 in 10 central banks believe that gold reserves will increase in the next 12 months. Our 2023 survey revealed that 24% of central banks intend to increase their holding reserves in the next 12 months. Furthermore, central banks' views toward the future role of the US dollar were more pessimistic than in previous surveys. By contrast, their views towards gold's future role grew more optimistic, with 62% saying that gold will have a greater share of total reserves compared to 46% as of last year. According to the Global Times, global de-dollarization trend is accelerating, and the current gold rush shows no sign of slowing. It's expected to continue in the coming month. De-dollarization is the main driving force behind global central banks' gold purchases. The precious metal will help them mitigate external risks that they truly have no control over. Thank you for taking the time to watch this video, and this is all for our economics project. Please, you can view the sources. I recommend that you do, and give us your comments whether you liked it or not and whether it's informative. And thank you again for watching.